Hello and welcome to this video where we'll be discussing the nightmare inflation forecast for 2023 by famous investor Michael Burry. Who is Michael Burry? For those who are unfamiliar, Michael Burry is a renowned American hedge fund manager and investor who rose to fame after being portrayed in the 2015 film The Big Short.
I'll start to sell my position. It's 1.3 billion. Sure.
He's known for his accurate prediction of the 2008 housing market crash and has been a vocal critic of US monetary policy. Recently, Michael Burry has been warning about the possibility of a significant increase in US inflation during 2023. What does his tweet say? Inflation peaked, but it is not the last peak of this cycle. We are likely to see CPI lower, possibly negative in the second half of 2023, and the US in recession by any definition. Fed will cut and government will stimulate, and we will have another inflation spike. It's not hard. Burry mentions the CPI here, and let's talk about that briefly. What is the CPI, or Consumer Price Index? It's often touted as the primary measure of inflation, but it is a fundamentally flawed concept. The problem with the CPI lies in its methodology and the fact that it fails to accurately capture changes in the purchasing power of money. Let me explain why the CPI is meaningless. First and foremost, the CPI only measures changes in a basket of goods and services, which does not necessarily reflect changes in the real cost of living. The basket of goods and services used to calculate the CPI is determined by government agencies and thus is subject to political manipulation. The weightings and composition of this basket can change over time, making it difficult to compare in absolute terms any changes in the cost of living from one year to another. Second, the CPI fails to account for changes in the quality of goods and services over time. For example, a new computer might cost the same as an old computer, but the new computer will have better features and be more efficient. By only looking at the price, the CPI fails to take into account the improved quality of goods and services, leading to a significant overestimation of inflation. And that can also work in the opposite direction. Finally, the CPI does not accurately reflect changes in the value of money. This is because it measures changes in the nominal value of goods and services without taking into account the impact of changes in the money supply. When the money supply increases, the value of each unit of currency decreases, leading to higher prices for goods and services. The CPI does not reflect this decrease in the value of money, which means it understates the real rate of inflation. So to summarize, the Consumer Price Index is a flawed measure of inflation which fails accurately to capture changes in the purchasing power of money. It's important to look beyond the official inflation statistics and understand the underlying economic factors that drive changes in the cost of living. Anyway, back to Burry. He argues that the combination of stimulus spending, low interest rates, and supply chain disruptions will lead to higher prices for goods and services. He also believes that the Fed's monetary policy of printing money will ultimately lead to hyperinflation, and Burry initially predicted the increase in inflation back in April 2020. So, what is behind the forecast? Burry's inflation forecast is rooted in the current economic situation in the US. The country is facing a massive stimulus spending program, low interest rates, which are increasing, and a decline in the supply of goods due to the COVID-19 pandemic. This combination of factors is expected to increase prices, and it's already doing that, and this is putting pressure on the US dollar, and it's leading to inflation. What are some implications of inflation? Inflation can have a significant impact on the economy and people's lives. It erodes the purchasing power of money, making it harder for people to afford everyday items. It can also lead to a decline in the value of the US dollar, making imports more expensive and potentially causing a recession.
I just don't think that the recovery is going to be that robust, and so I'm not terribly interested. Paulson's big in gold, and that's something that is interesting to me, and given how I see the world playing out.
Gold has been, for many thousands of years, universally recognized as a source of money, and central banks, it's the third largest source of money in central bank reserves.
According to the Global Risks Perception Survey, the top 5 currently manifesting risks in order of how severe people believe their impact would be on a global level in 2023 included the energy supply crisis and the cost of living crisis, as well as rising inflation and the food supply crisis. These were deemed to be the most severe risks humanity was facing. Just days ago, the Federal Reserve increased its federal funds rate, making borrowing more expensive while reducing long-term bond yields. The Federal Reserve had been keeping interest rates low for a long time. Meanwhile, we were also seeing an increase in money supply due to the stimulus package. This increase in the money supply is likely to lead to higher inflation in the future, especially since government debt now sits at $31.4 trillion, and the costs of servicing the interest on that debt is likely in the near future to climb to over $1 trillion a year. Burry also sees that the combination of stimulus spending and supply chain disruptions caused by the pandemic is leading to these higher prices for consumers. However, what industries does Burry think are most affected by the inflation? The areas of transportation, food, and energy are just some of those that he lists in his tweets. The costs of goods and services in these sectors have risen significantly, hitting consumers hard. The transportation industry has been hit hard by the pandemic, and as the economy has been reopening, we're seeing a surge in demand. This has led to higher prices for consumers. The food industry also has been impacted by supply chain disruptions, leading to higher prices for food products. There are several reasons why food price inflation is expected to rise in 2023. Weather events, extreme weather conditions such as drought, floods, and heat waves can disrupt crop production, causing a shortage of certain foods and leading to higher prices. Labor and transportation costs. The rising costs of labor and transportation can also contribute to food price inflation. As wages and fuel costs increase, farmers and food manufacturers may pass on these costs to their consumers in the form of higher prices. Increased demand. An increasing global population, along with rising incomes in developing countries, is predicted to lead to higher demand for food, which can also drive prices higher. Trade policies. Changes in trade policies such as tariffs and import or export restrictions can also affect the costs of food. For example, tariffs on imported foods can make them more expensive, while export restrictions can lead to a shortage of certain foods and higher prices. Finally, currency fluctuations. Food prices can also be affected by changes in currency exchange rates. For instance, if the value of a country's currency drops, imported foods will become more expensive for that country's consumers. So it's important to note that these are just a few of the potential factors that could contribute to food price inflation during 2023. The actual level of inflation will depend on a variety of economic and geopolitical factors, and this is always subject to change. As the global population continues to grow, demand for energy is expected to increase, leading to higher prices as suppliers try to keep up with that demand. Production costs, the costs of producing energy such as drilling for oil or building new power plants or obtaining gas or oil from other sources, can contribute to higher energy prices. As these costs increase, suppliers may pass them on to consumers in the form of higher prices. Government policies can affect energy prices. For instance, taxes or regulations on energy production and consumption can increase the cost of energy. Supply chain disruptions. Disruptions to energy production and distribution, such as natural disasters or geopolitical conflicts, can also lead to higher prices. Currency fluctuations, as before, like food, energy prices can also be affected by changes in currency exchange rates. For example, if the value of a country's currency drops, imported energy will suddenly become more expensive for that country's consumers. The world apparently is moving towards cleaner energy, and this is a transition that will require significant investments in new energy production facilities and infrastructure. This is a transition that is expected to raise energy prices as well. These are just a few of the potential factors that could contribute to energy price inflation during 2023. The actual level of inflation will depend on a variety of economic and geopolitical factors and are subject to change. What steps can investors take to prepare for this inflation? Burry would advise individuals to focus on savings and invest in assets that will hold their value, such as gold and real estate. As for investors, they should focus on companies that are well positioned to weather the economic storm, including those in the healthcare and technology sectors. They should be cautious as well about investing in bonds, because rising inflation will lead to a decrease in the value of bonds. Investors should be considering investing in inflation-protected securities such as Treasury inflation-protected securities or inflation-indexed bonds, which are designed to protect against inflation. It's always important to consider different perspectives when making investment decisions. While Michael Burry's predictions might not come to fruition, it's worth considering his outlook and taking steps to protect your investments. It's also important to remember that we have seen this before. Tangible assets, precious metals, and property should survive the transition to a digital economy. However, if there's a war, all bets are off the table.